Venugopal Garre joins us now, Managing Director with Bernstein. Venu, good morning. Thank you for joining us. Venu, if I scan at what the brokerage notes are for 2023, across the board, brokerages are of the view that this could be a year of flat to almost no return for Nifty. Are you with the consensus in terms of calling out that this could be almost like a flat to a no year, another year of no return for Nifty?
Firstly, thanks for having me on the show. You're right. So we've actually taken a very similar call that we would end up flattish 18,500 Nifty target. We actually had a target of 17,500 to 18,000 for the last year end, which is primarily was again a flat target. But I would probably argue that expecting 2 years of consecutive flat Nifty is not an easy call at all. And more importantly, the background inputs that probably went into taking this call is just largely reflecting uncertainty, because I guess it's an extremely tough year to call. Last year was very easy to call, especially from a top-down perspective on the index. And that's the reason why I think all of us are leaving room for flexibility later in the year to see how things shape up, especially globally, and probably reposition, how to look at India. And this is why the starting point is flat.
Okay, now history tells us that you normally, like you pointed out, 2 years of flat returns you've rarely seen in the history of Indian markets. What about the other part, which is that we may be in for a not a flat year of no returns, but a year of negative returns? I mean, there could be a case if uncertainty is so high, what looks like a flat year, by the time we unwind, we could be down 5-10%.
So, that's right. The way we look at it is that, the buffer for us, it's something like 16,000, which is probably the worst case that we are penciling in right now. It's a combination of what we see for earnings growth and, for the valuations going forward. But the reality is that for us to see, let's say, a 15% decline from here, you really have to see two things to happen, which are currently not our base case. One is, while macro is moderating, we need to see it to moderate very meaningfully. And number two is for us to expect that you see a rebound in crude and global commodities. Now, that's a very important call this year, because that primarily means that we are assuming that either the world is not moving into a recession, which means that global growth is strong enough to actually pull up commodities significantly high from where they are today, which is makes India vulnerable. So I don't call that a base case right now, but yes, there is a possibility of that happening. We still don't see a room for a 25-30% decline, because that's a hard landing. And I don't think the macro is in such a situation that you really need to call for a hard landing.
Let's look at your sectoral preferences. You're overweight on financials and have increased weight marginally looking at the comfort in the credit cycle. And given the significant underperformance last year, you also stay overweight on IT. I want to start with IT. IT is underperformed. The 2022 fall was the second highest after 2008. But is that good enough for IT stocks to make a comeback? Because we can argue back and say that if the global environment is so uncertain, what will happen to IT outsourcing? Because historical trends have indicated that when you are on the brink of a recession, IT outsourcing has collapsed.
Yes, so the way we looked at things, especially from the IT side of things, because there's been an ongoing call, we did make a lot of tweaks through the last 12 to 18 months. So the first tweak was primarily to not really take a broad-based IT call. Exactly 18 months back, a call would have been buy anything in IT, because we were fairly confident of the overall environment. We narrowed down that call to basically a handful of large caps, saying that, just one or two stocks that we should position or overweight with. And now what we've basically done is that we have essentially roughly 100 basis points overweight on IT, but we have primarily included the digital ecosystems, which is your new economy stocks. We have very few buy ratings there, but that has been included within the IT weights. That's the first thing that we have done. So technically the IT weights have reduced a bit, but nevertheless, we're still overweight even if we were to factor new economy. The second thing is we don't really see a situation where we are calling for a deep global recession, or we're not even calling for a situation like GFC, which is a situation of a bubble getting pricked. So this is one of the reasons for the title of the note is no bubbles, right? So which is primarily giving this view that this is more a possibility of a mild recession, which is very likely globally. Now, the second thing we highlight primarily is in such a situation where IT spend environment and the nature of IT spends has actually changed materially over the last 10 years. And especially these companies have also changed materially over the last 10 years. So two things help them. One is that growth may not necessarily be materially declining. There is an expectation that the growth will primarily decline, especially in terms of how the PE compression has happened. But it may not really reflect in terms of top line growth as much. Yes, there would be a moderation, but not a big collapse. Number two is on the margin side of things, we are starting to see a situation where there is immense flexibility to manage margins, which is, I guess, the I would say the positive side of the story. And these factors makes us believe that it is still better to be positioned, especially given the underperformance that we have seen last year.
Interesting. Venu, hi, morning. Wish you a very happy new year, firstly, and hopefully it's a prosperous one.
Thanks a lot.
Okay. So, Venu, outside of tech that you just highlighted your views on, I wanted to understand what is the investment strategy for the rest of the universe? Because, like you rightly pointed and highlighted in your note as well, that every sector is trading above the historical trading range, and therefore arbitrage opportunity gets very limited.
No, that is right. Ideally, I would have wanted to take a sector agnostic view and just look at stocks here and there, bottom up, which is probably the best thing to do in a year when you don't know where top down the market is going to head, in which direction and how much. But the reality is that some sectors to us still exhibit the sort of a situation where the underlying bottom up fundamentals still look fine to us, which is where our biggest overweight today is financials. We have been overweight in financials last year as well, but we've actually increased overweights to almost 400 basis points. So which means it's a spread across financial sector. Unlike our narrow view about 2 years back that we should only be with maybe top two or three banks. So that is one change, I guess, which we've done. The second thing is, look, end of the day, we are still in a situation where we have 2 years of broad-based economy weakness, which is non-urban, the rural areas, the broader bottom of the pyramid or the mid-income levels, where they've seen material challenges. In a situation where probably inflation will start to moderate and rural economy may be better, we have a chance for small value discretionary to, sort of start to recover, which is the reason why within consumption we went overweight on consumer durables, which is the other way we felt probably is the right approach to follow. These are the two sectors beyond IT, which of course is a combination of services and digital ecosystems, which is where we are sort of positioned as overweights. But at the same time, the argument is that we have narrowed down our focus, which means that we've actually cut wherever we could in terms of the positioning. So industrials, for example, we were overweight till about August, September last year. We moved to a neutral and now we moved to an underweight on industrials. So that's one of the changes that we have done. We have also sort of moved to an equal weight on telecom. We were overweight till last year. And we are underweight in consumer staples, which is also an underweight, which was sort of positioned just about a few months back. So which means that we're just focusing on a few areas, at least in the initial part of the year.
Underweight on utilities, metals, and more importantly, FMCG.
Yeah, so consumer staples, we are underweight. Our viewpoint is that why the intuitive view would be that, oh, if there's going to be a rural recovery, why not look at FMCG? But our thinking is that FMCG's margin recovery potential is already priced in as to where it is trading as a sector. It is better to be positioned in durables, which is relatively cheaper and potentially can give you a higher return relative to consumer staples, and that's how we are positioned. This particular sector. So we are underweight in FMCG.
Venugopal, given that the outlook is that inflation is going to moderate going forward, what's the outlook on the rural play and the agriculture theme?
Yeah, so I mean, we are actually playing agriculture in a very narrow way, which is primarily through durables. But the reality is pure play, rural demand, which is or players like the auto space, which are tractors. See, the outlook there is fairly okay. So I mean, things were okay even in the fag end of last year as well. So it's not really incrementally new trade. But that's also not a bad opportunity, not bad way to play it. I mean, we are overall equal weight in autos, but within that, the one of the stocks which is basically related to tractors, we are overweight on that name as a stock, as a single stock, right? So we are playing it that way as well, beyond consumption.
How should one read into when you see headlines which say Tesla's down 70%, a good owned, well, stock like Apple, which is not very expensive, which has got a lot of cash, suddenly is down 30%. Do you think we should somewhere be prepared for some kind of an casualty given where the US financial markets have moved and the spillover effect of that?
The interesting thing is if you see the last 12 to 18 months, the technology sector has been the one which has seen the material hit, and especially because they were disproportionate beneficiaries of COVID. So from 2019, and I wouldn't call out services, I would probably call out pure tech, which is basically a lot of these hardware companies and other ecosystems, which includes e-commerce players. So we've seen non-linear growth for quite a few of them over the last 2 years. The reality is the unwinding there is much more material hence, because there's a real potential possibility of earnings downgrades being more meaningful out there, and the outlook not necessarily changing for a couple of years, right? So I'm not calling out a specific stock there, but some of them, of course, had other issues as well in terms of management attention towards the company and things like that. But I'll put that aside. But the perspective is that, and hence I don't think we should extrapolate that as a call on the broader market, which are the normal companies in the world, because things have been very different for them in the last 1-2 years.
I guess this is an evolving story. Venu, we'll let you go now and we'll speak again soon.
Thanks a lot.
Thanks for joining in.